Hello and welcome to today's webinar on public sector financial recovery following COVID-19, brought to you by Public Finance and the Crown Commercial Service. I'm Colin Mars, Editor of Public Finance. I'll be very interested in hearing about a very important topic for finance professionals working in government at all levels. Following a period of furious spending to deal with the impact of coronavirus, the focus is now starting to shift towards ensuring that public finances can recover. So today we're going to look at how the public sector can repair their accounts by saving, generating and recovering funds. The session will cover a number of topics, including how looser procurement rules helped authorities during the pandemic, where savings are left to be made after a decade of austerity, and the sensitivities of recovering debts or erroneous payments while maintaining relationships with suppliers. We can have three 15-minute presentations, followed by 15 minutes of questions for the panel. We're very keen to hear your questions, so please click on the link which you can find in your event console to submit any burning questions that you have. So we're going to hear from four speakers today from Crown Commercial Service. We have Paul Allison, Deputy Director of Financial Services at CCS. Paul Bentley will also speak, Category Lead of Financial Services at CCS. Matthew Hooper, Senior Commercial Lead of Financial Services at CCS. And Jan Coleshaw, Commercial Agreement Lead, Financial Services at CCS. So without any further ado, I'll hand over to Paul Allison and he will take it away.
Thank you very much, Colin, and good afternoon, everybody. Thanks very much for joining us on this webinar. As Colin said, my name's Paul Allison and I head up the Financial Services Group at CCS. Before we get into the heart of the presentation, I just wanted to give you a brief intro to CCS. Now, no doubt some of you will have heard of us, but for those of you who haven't, we are a public sector organisation. We are in fact an arm's length body of the Cabinet Office, but we do cover the entire public sector. So the framework agreements that we established to allow the public sector to buy common goods and services such as vehicles, IT, building works and so on are used by everybody from the largest government department to the NHS, local government, emergency services and so on. Last year, over 19,000 public and third sector organisations used us for one thing or another. Now, what that gives us is a really, really rich view and understanding of the challenges, not just faced by the public sector, but by individual organisations within the public sector. Most commonly, of course, each part of the sector faces its own challenges. So typically what troubles local authorities will be different to what troubles the NHS, for example, or schools. But it's very obvious, however, still very true to say, that the financial impact of COVID has affected us all and deeply, and continues to do so. Latest figures announced a couple of days ago show a public finances deficit of £24.3 billion for May 2021. Now, I love that being reported as an improvement, which I suppose, strictly speaking, is true, because the same period last year showed a deficit of £43.8 billion. But no one's kidding themselves, of course. Public sector net debt stands at 99.2% of GDP, which is astonishing. And COVID-related spending continues to drive borrowing. So I suppose, relatively speaking, the situation is clear, but the solutions less so. And you will all be facing challenges in your individual roles. Across the next 45 minutes or so, and as Colin said, we'll leave 15 minutes for questions. So across the next 45 minutes, we'll be giving you our views on some key areas. And to be clear, this is not just about ensuring that your organisation gets value for money from every penny spent, important as that is. Today's session is more focused on some thoughts around income generation and fund recovery. So again, not the complete solution, because clearly there are many angles to this, but hopefully some ideas that you will find helpful and some discussion that you will find interesting. We'll talk too about the important role you can play when it comes to social value in supporting supply chains and local economies. Various procurement policy notes have been issued in the last year, all in response to COVID. And the recent National Procurement Policy Statement specifically mentions helping our communities recover from the pandemic. And we all have a role to play in supporting that, but also in supporting our own organisations recover too. So on that, I will hand over to my colleague, Jan Coleshaw. Many thanks.
Thank you, Paul, and good afternoon, everyone. My name is Jan Coleshaw. I'm the category lead in financial services, and I have responsibility for payment solutions and payment acceptance categories. For this section, the focus is on procurement cards, and I am delighted to have this opportunity to speak with you today. As COVID-19 presented itself, the Cabinet Office acted really quickly to issue procurement policy notes. The PPNs shown here wrap around the procurement life cycle, and they provided important instructions and guidance on how central government departments and the wider public sector could procure goods and services at a time of extreme urgency. To support the continuity of service, the PPNs addressed the urgent need for direct award, applying extensions, enhancing spending powers on how to buy, and accelerating cash flow to suppliers. Taking a closer look at PPN 0320, which the Cabinet Office issued on the 6th of April last year, the procurement cards, as we know, is the recommended payment method when purchasing common goods and services, as per the pan-government policy. Their use is endorsed by Gareth Rees-Williams, Government Chief Commercial Officer, in the quote that you see here. PPN 0320 had two very distinct aims. Firstly, to give contracting authorities greater spending power and to broaden their use of procurement cards. It did this by increasing the single purchase transaction limit to £20,000 and the monthly limit to £100,000 for key cardholders. It required contracting authorities to open as many merchant category codes as possible to increase the range of goods and services that could be purchased. Secondly, by paying with a procurement card, it would really accelerate payment to suppliers, improve cash flow, and overall help the economy. (2020) was a year unlike any other, with specific impact and significant impact on how we live and work. And it is of no surprise that this affected overall payment volumes in the UK, which declined by some 11%. Lockdowns and home working reduced travel and general spending, but despite the overall decline in payment volumes, card-based payments continue to increase, with 52% of payments having been made by a card product. Pre-COVID, and specifically for the procurement card product, spend was prominent in travel, and during lockdown this switched to health. As restrictions are lifted and we move forward through recovery and beyond, we expect to see some bounce back and some new spend in different categories emerge. CCS recognise that procurement cards is but one method of payment, and there are several methods, including debit and credit cards, BACS, direct debit, to name a few. Each payment method has its own benefits, and we choose the method that best suits our needs. And over time, we might continue to reach for that same method, maybe taking the view, if it's not broke, let's not fix it. All I would say is that it's useful and can be very beneficial to have periodic reviews around payments to check if internal processes are efficient, has anything changed, and is the right payment method being used. So what is a procurement card? They are used to make business-to-business payments, where the card payment account has controls built in around spend value limits, the types of suppliers, and the types of purchases that can be made. The service is free to use, there is no setup or annual card fees, and contracting authorities using procurement cards will receive an annual rebate just for making purchases using their card programme. CCS are proud that our procurement cards saw £7 million returned back into the public sector for 2019-20. The procurement card product is robust, reliable, secure and efficient. They've been in use for 24 years under alias names such as EPC and GPC, which you may recognise. And with technology and innovation, they've developed into a suite of card-based products supported with an online portal with very powerful tools. There are three types of card that contracting authorities can use, and contracting authorities tend to use a combination of all three types. The plastic card, the original product, this is the same as what you would carry in your purse or wallet. The lodged card, where the card details are digitally placed within the contracting authority's payment system and used to pay supplier invoices. And the virtual card, where we're seeing much greater use. Typically, these are used for making one-off payments online and allows for a virtual card number to be generated to pay suppliers without you ever needing to disclose the actual card details. So what are the benefits of procurement cards? There are lots of benefits, both for buyers and suppliers, and I'll cover the most salient points, although please note they are very much interlinked. Unlimited scope, basically what it says on the tin. They're not just used for travel, which is a misconception. You can use procurement cards to buy anything for your organisation. That may be from stationery to a school bus and absolutely everything in between. They save you time and money. Procurement cards streamline the business process, making it far more efficient. They eliminate several steps within the traditional procure-to-pay process, removing the need and administration costs associated with raising purchase orders and processing invoices. The online portal provides efficient reconciliation tools, making it much more efficient for your organisation. It uses transaction data to automatically match transactions, and this has and also has the flexibility to allow manual matching when that is needed. Some organisations who have switched to using procurement cards have reduced their invoicing by up to a staggering 45% and have benefited from a 35% saving in processing costs. With suppliers paid and having removed the noise around volume invoice processing, all that remains to be done is a single monthly payment to card providers to settle the full account balance. So as you can see, there are lots of efficiencies that can be had to your internal systems. COVID recovery and better rates. Paying by procurement card really accelerates payment to suppliers, as they can receive payment within 4 days from purchases of the goods or services. This is opposed to the typical 30+ days under traditional invoicing. And as early payment is of value to the suppliers, it can negate any concerns that they may have around attracting industry card fees. From a buyer's perspective, it's also great news, as the early supplier payment is made by the card provider, which means that a contracting authority will retain the funds within their bank account for longer and accrue interest up until the next settlement date, when they need to settle the account balance in full with the card provider. This interest gain period can be as much as up to 43 days. Other tangible benefits include developing stronger relationships with suppliers, and this can lead to improved service, closer working, and maybe preferential pricing. A key feature of the procurement cards is the rebate that is paid back to contracting authorities. The value of rebate is based on a percentage of the total annual spend using the procurement card. Therefore, the higher spend on card, the higher rebate payable. This can be a really valuable source of funds redirected back into the public sector and for use within your core services. Taking monitoring and management and control together, the financial services industry is a heavy regulated industry by the Financial Conduct Authority. As such, robust systems and processes and procedures are in place to ensure that payments are made securely and reduce the risk of fraud. All procurement card transactions are protected by the chargeback guarantee, and the usual fraud measures apply when the cards are used in line with scheme rules, that being Visa and MasterCard. The online portal provides a layer of control in its setup and visibility of transactions. The system can be configured to purchasing policies and to permit or block spend with particular suppliers. Using merchant category codes, actual products and services can also be permitted or blocked. Again, this adds greater control for contracting authorities. You can also view transactions awaiting statementing. This early visibility is an added control that allows for early investigation and resolution should any queries arise. Contracting authorities will have administrator access, which really enables them to manage their card programme. This allows them to add and remove users or amend transaction spend limits on cards. There is a suite of reports available, including statements and including the statement history, and these can be viewed online or downloaded in several formats. There's lots more other functionality available on the management information side of things. So in terms of maximising use and some takeaways, what I would say is think across your organisation on where you spend and question if the payment processes can be made more efficient by using procurement cards. Think current and future spend, projects in the pipeline, or immediate recovery projects. The bigger and broader use of procurement cards will generate internal efficiencies and savings when switching from a more labour-intensive process. Even if you were achieving efficiencies through consolidated invoicing, think about dropping in a procurement card at the back end of the process to make the payment to suppliers. This will all count to your card spend and increase the rebate payable to you. If you have concerns about increasing spend levels to that of the PPN, take a stepped approach and gradually increase those levels to gain confidence and take it progressively from there. Develop strong relationships with your card provider. They have great insight to payments and suppliers, and they will be able to work and help you to make sure that the right card solution is in place. Partner up to form a customer cluster and use aggregation to combine your buying power so that all parties can benefit from a higher rebate. If nothing else, lodge a card with your top spend suppliers to improve your rebate. I'd like to thank you for listening, and I hope this information has been useful. I will now pass you over to my colleague, Paul Bentley, who will talk to you about spend recovery.
Thanks, Jan. A fascinating insight there in how we can spend efficiently and generate income at the same time. Good afternoon, everybody. My name is Paul Bentley, and I'm one of the category leads here at Crown Commercial Service, and I'm here today to talk to you about spend recovery. Primarily, we're looking at this in a COVID context or post-COVID context, but spend recovery has a relevance to you and your department or organisation, no matter what the underlying circumstances may be. As far as this presentation is concerned, I only have a few short slides, so don't worry, no death by PowerPoint here. But hopefully by the end, you'll see how embedding spend recovery into your financial processes will be financially rewarding, cost effective, and provide an additional layer of financial assurance in your supply payment processes. So let's get the ball rolling with a nice little fun fact. Did you know that of all the policies implemented by President Obama, spend recovery was one of the only policies that President Trump kept in place? Every US government department must conduct a spend recovery exercise annually, and in 2017-18, from a spend of $4 trillion, the US recovered $141 billion of supplier overspend and improper payments. Okay, so that's our neighbours across the pond. Let's look a little closer to home. 1/3 of all public sector expenditure is on goods and services. The government data we access here at CCS also tells me that local government
spend for 2019-20 was £62 billion. When we look specifically at COVID-19 related spend, so literally additional spend in the last 18 months or so, plus an estimate for future COVID spend, the Office for National Statistics believes we will spend across the whole of the public sector £372 billion. These numbers are huge, and if there's one thing I know for certain, it's that there will be significant overspend in the form of error payments to the suppliers we use daily for those goods and services. I believe, well, in fact, I know that every year millions of pounds of your budgets is overspent. The overspend I'm talking about is primarily duplicate payments, incorrect values, unclaimed credits, and unapplied contract volume discounts. There are numerous factors as to why these overpayments happen, but the important thing to recognise is that they actually do. What we will also have to accept is that as we followed the directive of number 10 in the Treasury to continue to pay contracts as a matter of urgency to ensure their survival, errors almost certainly increased in number during COVID. The procurement policy notes that Jan referred to enabled us to support the economy, but they also opened up the door to increased error. But with the best will in the world, there was no way we could avoid it. Tight-knit teams of colleagues working side by side, checking and double-checking invoices and statements, were now working from home with inadequate IT and with no easy access to a colleague or office systems. Suppliers were paid early, paid in advance, and paid outside of standard operating procedures. The industry estimates for overspend that the industry estimate for overspend is 0.1%, or £1 million for every £1 billion spent. If the ONS is correct, with COVID spend at £372 billion, this gives a potential overspend of £372 million. I'd like, if I may, to take a little bit of time to talk about accounts payable audit software, or fiscal software, as it's also known. Many of you will be aware of what this is, and in a nutshell, it's a software application that integrates with any existing AP system to identify exceptions in supplier and transaction data. Because of the way these solutions are marketed, it wouldn't be wrong to think that if you incorporated it into your AP system, you would be safe from error. But unfortunately, that just isn't the case. Exception software is a great tool, but it only does part of the job. Effective error recovery requires human as well as artificial intelligence. Skilled recovery consultants know where to look to find literally hundreds of thousands of pounds of overspend that AI simply would not see. Spend recovery needs both HI and AI, but in my view, that human intelligence is far more important to utilise. Hopefully to this point, I've convinced you of three things. One, errors happen. I'm sure you are aware of that. Two, software isn't enough. Maybe you thought it was. And three, human intelligence is the key to recovery. So I said at the beginning of my presentation that I was the CCS category lead for spend recovery. I'm actually very proud of the work we do in supporting organisations such as yours to recover money back to the public purse. Last year alone, our suppliers returned over £15 million. And in my view, we haven't even scratched the surface. And you know what the best thing is about that? It came at zero financial risk to our customers. So why was that? Well, basically, our suppliers, they recover money and they operate on a gain share cost model. This means you have no financial outlay and you only pay a percentage based on the sums recovered. As this slide shows, we access your data, we analyse that data with HI and AI, and we recover. It really is that simple. As a real example, Olga Bennett is one of the heads of finance of the London Borough of Brent. Just over 12 months ago, she entered into a contract with one of our suppliers and recovered just under £1 million. Olga would be more than happy to chat to any colleagues who get in touch with her. And here's another fun fact. Anecdotally, London boroughs recover significantly more than authorities in other regions. If you're here today from a London borough, please get in touch. Oh, and by the way, Brent has fiscal software. COVID-19 has put immense financial pressure on all of you. Budgets have been stretched and extra pots of money have had to be found to support supply chains. Spend recovery gives you the opportunity to take stock, to take a detailed look at your payments and return any monies that should be in your accounts and in part repair those budget stretches. All of this can be carried out with sensitivity and understanding. Monies identified for recovery don't have to be recovered, but can instead be offset against future purchases. Each supplier can be dealt with on a case-by-case basis, ensuring that relationships are maintained. I'll leave you, if I may, with one final not-so-fun fact. Did you know that there is a known practice of suppliers writing off a credit debt in a sales ledger? Although not exactly legal, the HMRC guidance around this isn't clear. This has resulted in suppliers writing off credits that have not been claimed. One day they're on the supplier statement, the next they're not. Timely intervention with spend recovery will enable you to claim back thousands, if not hundreds of thousands of pounds. If utilised regularly with other tools, it demonstrates a true belt and braces approach to financial management and due diligence. Consider implementing that today. Thank you for the opportunity to speak to you. I look forward to taking questions at the end of this session, but for now, I'll hand you over to my colleague, Matthew Hooper.
Thanks, Paul, and hello to everyone. So I'm going to talk about debt recovery, and I've got a bit of a captive audience, which is quite nice because normally when I talk to my family about debt recovery, their eyes glaze over somewhat. But this is a really, really important topic, obviously. I'm not going to repeat what my colleagues have said, what Paul said at the start of this call, in terms of the pressures that are on you to maximise your budgets. We're in an almost perfect storm when it comes to debt recovery. This time last year, you only had to open a newspaper to see the headline "Debt Tsunami" headed our way, and it's been a regular talking topic to many people that I speak to. And there's a real balancing act needed in this space, I think, particularly around the challenges that you have in terms of budget, but also the challenges that the public have in terms of the impacts of COVID on them. So we've got an almost perfect storm of the vulnerability and the challenges around recovering debt in that space. I was talking to someone from a credit reference agency recently who was telling me that the numbers of corporations that had entered insolvency over the last 12 months are actually lower than they would expect in a normal financial cycle. The debt advice charities have actually said that the levels of debt advice that they've been given out have dropped. They haven't been given out too much debt advice over the last 12 months. And why is that? Because everyone was obviously expecting those numbers to go through the roof. I think the simple answer is the support that you and the government have given to those organisations and those individuals to keep them afloat and support them. And that's been invaluable, but it hasn't made the problem go away. Many would argue that it's kicked the can down the road somewhat, and that when government support eventually ends, there will be a significant issue around debt recovery and indebtedness across the country on an individual basis. The same credit reference agency were telling me that of all mortgage holders in the UK, 45% had taken advantage of creditors' COVID support schemes. So almost half the mortgage holders in this country have taken advantage of debt repayment holidays or similar, which is quite a frightening statistic. And we know that many people have become better off as a result of COVID, but we also know that many more have become far more indebted and are entering problem debt. And the challenge that's posed to you guys is how do you separate those? How do you make sure that you treat the vulnerable appropriately, but recover the maximum amount of money that you possibly can? And is it right to even do so? So one of the things I think the first questions to answer is should we be talking about debt recovery? Is it the right thing to talk to when the public are in such dire finances? And this slide talks to some data research done by one of our suppliers, a company called Endesa. And this was last year, but it does show, and these numbers incidentally agree with the majority of other polls that I've seen over previous years, and the overarching view that the public believes that it is the right thing to do to collect debts from those who owe them, and are supportive of that. And I think there's an important asterisk aligned to that, though, and that asterisk is where they can afford to pay it back. I don't think anyone is supportive of trying to squeeze blood out of a stone, and it's not the right thing to do, and it doesn't make sense commercially either. So when we're talking about how to make drive the greatest returns for your organisations, commercially and in terms of socially and social responsibility, it makes no sense trying to chase people who simply can't afford to pay you back. And in fact, what we need to do is offer them the appropriate support to help them get out of debt in an appropriate way. And this is where we talk about things like fair outcomes and treating customers fairly. And these words don't mean not chasing debt. They don't mean ignoring people. They mean finding the right solution for the right person at the right time. Those circumstances change over time. Vulnerability can be temporary, it can be reoccurring, it can be permanent. And what you need to do and what we need to do is understand the circumstances of individuals and businesses and tailor our approach to that. And part of the challenge then to you is making sure you've got the right armory in terms of the tools available to support debt recovery, and also the information available to you to support debt recovery, which is really, really important. And that might be internal. That might be looking at solutions and finding the right solution, whether that's using debt collection agencies, if you're looking externally, whether it's looking to litigate, whether it's looking to use enforcement, but making sure that that solution that you choose is the right solution for the individual consumer that owes the money. And how do you do that effectively? You do that effectively through segmenting your customer base by creating bespoke treatment paths to consumers who are in individual circumstances with common attributes aligned to them. So what do I mean by that? What does that actually mean? How do you do it? Well, I've taken literally copied and pasted some context here from the cross-government debt management strategy, talking about the use of data and analytics. And this is really how you start to understand the circumstances of those people that are indebted to you, and how you start to segment those customers into different bespoke treatment paths to enable those that need support to be directed to support, those that can afford to repay you to work with them to create affordable repayment plans that deliver fair outcomes for you and them as consumers. And those, frankly, that are either fraudulent or just trying to get away with it, equally get appropriate treatment to know that that is not an option. They have to pay the debts when they are due. So I won't go through the bullets there, but they talk about some of the benefits of using data in this space. And the diagram on the right-hand side talks to some of the solutions that we have through our frameworks that utilize data to help provide solutions in this space. So what we do is we take data from creditors, so the data that you hold. we enrich that, or our suppliers enrich that with other data sources. So in the example here, we've got the standard credit reference agencies, which will provide significant data around consumer circumstances. And what's interesting is actually a lot of that data is being re-looked at and reassessed in light of COVID. So when you look at traditional credit score data, there's a somewhat of a lag on that, because the credit bureaus are updated every month or so at best. So there's now a trend towards looking at more real-time data, such as open banking, for example, that helps enrich that. But also to look at things like trending data. So you can actually now tell if Matt Hooper owes you some money, you can actually now see that Matt Hooper used to pay his credit card in full every month, but over the last 3 months he started paying the minimum payment. So does that identify, or does that suggest a change in circumstances that means perhaps Matt's in a little bit more financial difficulty than he was 3, 4, 5 months ago, and therefore should we be treating him slightly differently as a result of that? Excuse me. So in terms of what does that look like in real life, and how does this affect your segmentation processes, and do you segment at all in terms of how you collect the debts? So often what people will do when they look at debt profiles, and quite simply when they look at the resource required to chase debt profiles, they'll look at the value of the debt. So I've got 2 examples here, and you can pretty quickly see where they're going to. But the example on the left is a consumer that owes £5,000. The example on the right, a consumer that owes £9,500. And at face value, when you're looking at how do I best maximise and use my resource here, where do I focus my resource, where do I spend my money chasing this debt? If you've just got that information, you may well say, actually, I'm going to segment by debt value. I'm going to put the highest value debts down the most intense credit collection strategies that I can. They're going to cost me the most, but the debt value is the highest. Well, what you can pretty quickly see here is by enriching the data that you have with credit bureau data, that view changes. So the consumer on the left, although they only owe £5,000, we can see they've got a really good credit score. All their credits up to date, and actually looking at that trending data, this might be a consumer that's actually better off through COVID. They've actually fully paid off some debts recently, and I can see that. The individual on the right is a bit more of a sorry tale, a bit more unfortunate. We can see they've got multiple credit card debts, arrears, multiple searches from debt collection agencies. That trending data has gone the other way, and they're now paying minimum balance on some of those credit cards. And actually, what I can see from the credit bureau data is there's some different addresses for this individual. So the address that I have might not even be the right address, and the letters and contact I've tried to deliver might be just sinking into a black hole. So the data that you can bring from external sources really gives you a far more enriched view of those consumer circumstances. And when you add that data to the analytics, and you start to look at grouping those consumers together and seeing how those consumers behave and what happens to the liquidation of those debts, you can see actually the individual on the right, people who look like that typically behave in a similar way. And we can see the numbers on this sheet that I can expect typically a 75% debt recovery from that debt, which would deliver £3,750 back. That's what I should be expecting from that individual. The person on the right actually looks like it's not very good circumstances at all, and other consumers with similar profiles, my experience tells me I'm going to only recover £950 from that, which obviously tells you quite a different story when you drill into that data from the high level debt values. And the question you now ask yourselves is, okay, where do I want to put my money now? Where do I want to put my resource now? Where do I want to spend money recovering that debt now? And actually, when we're talking about social value and delivery of social value, how do I support the individual on the right to, from a socially responsible perspective? Should I be signposting them a bit more strongly to debt advice? Should I be trying to get in contact with them, put my arm around them, help them, protect them from any further indebtedness? And I think that really brings to life where you should be looking and how you should look to segment some of those issues. And there's a little stat on the slide that talks about the debt market integrator, the DMI framework. through using data and analytics, through the use of debt collection agencies in this case, they're actually delivering a return on investment of every £1 you spend, £17 is recovered. So again, the message around intelligent segmentation, using data and tools available to you, delivers you the best return, maximizes the recovery to you at the best commercial return on investment, but is also vital to protecting the consumers and understanding the consumers' circumstances and supporting that social value perspective. So I think in summary, the more information you can get, the more specific you can tailor your approach. The more specific you can tailor your approach, the better return and commercial return on investment that you will get. So on that note, I think I'm going to hand back to Colin or Paul for any questions. Thank you.
Thanks very much. It's Colin here. We've got a number of questions in, so we'll try and get through as many as we can in the time available. The first one is a housekeeping one, which is asking whether the participants can get a copy of the slides after the session, because some of her colleagues couldn't attend, so it'd be useful for them to have when they're feeding back.
So I think from our perspective, that's more than possible. We can certainly share the slides, not a problem.
Fantastic, that's good. How would people go about getting those?
We'll link in with the organisers, and we'll share those to the distribution list, I think, unless someone tells me otherwise.
Yeah,
No, that's right.
no, I believe a PDF version of the slides is going to be created. That can be sent out to those who have been here today.
Great. Fantastic. Okay, then moving on to some more meaty questions. We've got a question here asking, in relation to spend recovery, is this not something that the government could do for itself? Is there a case to be made for investing in a government-owned and delivered solution?
Yeah, so I think it's a great question. I wouldn't say it only applies to HM government. I suppose the question is, could any public sector organisation, kind of insource this, do this for themselves? I think the question, and I think I'll pass over to Paul Bentley, expert in this field, but from my perspective, I think it's about understanding, what are those things that we as public sector organisations should be focusing on? And yes, what we should be doing is looking to prevent in the first place. I think prevention is always better than cure. Prevent in the first place overspend. But as Paul showed in his presentation, it happens. And then I think the question is, who is best placed to recover that? Paul, what thoughts do you have?
Yeah, it is actually a great question. Unfortunately, I think Alan's had to leave the call at 1:30, but I think it's relevant to many other people who are listening. There is a definite argument for this. Actually, I'd love to head up that team if the process was mandated, as in the US. I think there's an even stronger case for it. I suppose it's about incentive at the end of the day, because of the way the cost model is set up for our CCS service. The private sector suppliers are incentivized to dig that little bit deeper. So maybe a government JV would work for something like this. But yeah, a definite great question, and something maybe we should be thinking about.
Great. Okay. Moving on to the next question. This is about strategies. Have you seen any significant changes to debt recovery strategies as a result of COVID-19?
Matt, I think you'd be best placed for this one.
Yeah, thanks. Yes, absolutely, we have. We've seen a far more cautious approach to dealing with consumers. We've seen communication strategies in terms of letters that are issued significantly softened from where they were previously, offering being far more supportive. So some organisations in the private sector, for example, have almost stopped talking about debt recovery in some of their letters, and talked about just get in contact with us. We know times are difficult. Let's just have a conversation. And for those that are close to this sector, you'll know that engagement is probably 80%, 90% of the battle in this case. So just getting people to have the confidence to phone up and not bury their head in the sand is a critical piece. The other significant area that I've seen in terms of strategies is obviously the challenges around using enforcement organisations at the moment, and the various restrictions that have been placed on those through COVID. We've seen a lot more organisations that used to go straight to enforcement looking at other solutions. So whether that's in-house collections or looking at debt collection agency strategies, again, designed to be a bit more softer, a bit more tailored, moving away from perhaps the proverbial sledgehammer to crack a nut approach, and trying to get a bit more bespoke and subtle in terms of the engagement. So I think the overall view is yes, absolutely, and it's around a softening of approach to consumers.
Great. Okay.
I think one comment from me on this, Colin, would be, obviously we've seen a much more heightened political lens on debt recovery and spend recovery through the post-event assurance. So I think because of that, organisations are starting to look at this kind of more deeply. And I know that in my category area, spend recovery, we're seeing a much greater kind of uptake.
Fine. Great. Okay, that's really interesting. Another question. This, I don't know if you may be able to answer this one, see how you go, but this is asking, going quite to a macro level. It's saying that income generation was obviously mentioned in the introduction. So it might be beyond the remit of the CCS, but one way in which local authorities can generate more income is through greater flexibility in raising taxes. And the questioner points out that local authorities' hands are tied by excessive treasury control at the moment. So the question is there any chance of such control from the centre being relaxed, and can things like tourist taxes help?
Sure. Yes, I think I would very much ask if Rishi Sunak is on the call. If not, I think you're absolutely right that this is beyond the remit of CCS, but it's an interesting point, of course. I mean, this of course is about, as Colin said, quite a macro position, recovery of the economy essentially, and tax. I mentioned earlier on that we will be looking today in our presentation at some of the angles of this. Tax, of course, is a very significant angle, but very much so one for our colleagues over in the Treasury.
Okay. If that's it, I will move on to the next question, which is what kind of reaction do you typically get from suppliers who have been contacted about an overpayment and who are being asked to pay it back? One would assume it's always a negative one.
I'll pick that up.
Very good question. Yeah, Mr. Bentley?
Yeah, I think it's fair to say it's a mixed bag. I think hence why I said in the presentation that these things need to be dealt with kind of sensitivity and understanding. I think if we're looking at the kind of the larger suppliers, your larger kind of telecom suppliers, energy suppliers, etc., there's no kind of pushback, because they just realise that they've got that money there in the first place, and they should have given it back anyway. But yeah, I think obviously with the kind of the smaller suppliers, there will be instances where they will seek alternative ways of kind of managing this. Hence why I said, it could be offset against kind of future purchases. But I think it's fair to say it is a mixed bag.
Thanks, thanks, Paul. I'll pick up in Colin while Colin has a look through the list. I've got another question here, which is, what do you foresee as the problems that might be created when government pulls back on its COVID financial support? Yeah, another very, very good question. I think the implications are obviously quite widespread because government support, of course, has been across the entire economy. So it's kind of a case of where do you start with that one? I think, obviously, if I think about the public sector, naturally, I think there is potential risk to our supply chains. Of course, the PPNs that Jan mentioned earlier that were published last year, a lot of those were in response to supporting our supply chains and ensuring the continuity of services and provision of goods to us all, which of course then reached its way out to the front lines, to our citizens. So I see, a challenge for businesses actually. I think I also see that putting even more pressure on the public sector to support its supply chains, which kind of takes me back around to what Jan said in terms of, how do we then ensure that when we are paying our suppliers, that we are paying them as quickly, as efficiently as possible? And also to Matt's point as well around, does that then lead to even more sensitivity in terms of recovery of debt from businesses? And also, if I touch on Paul Bentley's section, do we then even become more sensitive about recovering overpayments? So more questions to be answered for sure, but yeah, without doubt there will be implications from the slowdown of recovery from central government there.
Paul, can I just add to that again in terms of looking at the individuals and consumers out there? I mentioned that debt advice had actually dropped off through COVID because of the support that government's given to individuals. I think as those support schemes end, as furlough ends and other schemes end, there are a lot of people that are forecasting a significant jump in insolvencies, both personal and corporate insolvencies. And I've actually seen forecasts suggesting that personal insolvencies may even double going as those schemes end. So that's going to put even more pressure on individuals. It's going to increase the number of people in significant financial distress and indebtedness, which again is going to make the challenge in terms of working with those individuals, recovering money, the levels of arrears rising is certainly going to be there as well.
Great. Colin here again. Got another question coming, which is, what is the UK public sector card usage worth to the card operators and banks, and how does that relate to the value of the rebates or third-party supplier charges?
Thanks, Colin. I think so. That is a really tricky question. So I think that, one of the good things I can say about, an agreement such as, so the payment card framework agreement that Jan mentioned in her session, there are around about 4,000 public sector customers already using that agreement, which is obviously a huge spread of organisations. But what I touched upon, but perhaps only slightly in my introduction, was that this is not just about value for money, but of course it is, and that will always be important. Now, what the framework agreement allows us to do, because we have such a high usage within it, is ensure that the banks are taking as little as possible out of this and that rebates are as high as possible. What we can't control are the fees that the schemes will apply and the merchant banks will apply to the actual suppliers themselves. But where we are able to influence the cost within the supply chain, we do so. What we will do, as I said earlier, the answers to all questions asked today will be shared out, and we will share the answers a bit more granularity once they get shared around.
Great. Okay. The questions are coming in thick and fast here. So the next one is about the tension between chasing debts of social services clients and those clients' legal rights to access those services. Do you see any tension there?
Matt, do you have a view?
I think this goes down to understanding the circumstances of the individual, and I think if you take the time to engage with those individuals, so that data will tell you a lot. Data will tell you a lot of things. It doesn't tell you everything, and this is why you still need really good people engaging on the phones. Talking to consumers to understand their circumstances, and that might be things like making sure if you're using a debt collection agency, using an FCA regulated debt collection agency, to make sure that the person on the end of the phone has the skill set and the rigor and controls around them to really get under to understand the individual circumstances. And I think this comes back to everyone's ability to repay. If you talk to someone and they can afford to repay a debt without it putting them under additional financial distress and circumstances, then that may well be the right outcome. If you're talking to them and they're in such a situation that they're on benefits, they've got a negative income and expenditure, then clearly actually understanding that adds more value to you. So engaging with that person, understand their circumstances, is actually a better position than you were in before that, when you might not have known those specific circumstances. And then again, you can tailor approach to give them support, help, or advice accordingly. So I don't think it should be an automatic barrier to looking to engage with them, but it needs to be caveated about that engagement needs to be right.
Thanks.
Great. Another one here is asking about whether you think some organisations have a fear of payment cards, and I guess the implication of that is what should you do to get around that fear?
I'll certainly bring Jan in for this one. I think from my perspective, I think the answer is absolutely yes, and I do understand that to a certain extent. Actually, I think we've all seen over time news about the misuse of P cards, and I think predominantly in those organisations where there is that fear, I think there is a sense that P cards are or tend to be primarily those pieces of plastic that are handed out to people to pay for train tickets and so on. Without doubt, the controls that are in place now, from a technological point of view as well as a process point of view, are much more elaborate and sophisticated. And also, it's the different forms of P cards, as Jan mentioned. So, virtual cards, lodge cards, where they are not literally in the hands of somebody. I think the other way of overcoming that concern or anxiety or whatever you want to call it is in speaking to other organisations in the public sector who have deployed P cards in strategic ways. And to see, really how this can work and how controls can be put in place. And CCS is able to connect organisations with others who do use cards in such a way. I don't know, Jan, do you have any thoughts?
Thanks, Paul. I think you covered all of the salient points there. To be fair, it is worth drawing out that the products have moved on, as you say, with technology and innovation. It is the finance industry, so it is all about making payments secure and controlled, and also with technology advancements, whereas it was originally the piece of plastic that you held in your pocket, there is much greater use of lodged and virtual cards. We live in a digital world now. So there is greater use of virtual cards coming through, and the same way that in our personal lives that we don't always stay with our insurance company. We review where our payments are, and we switch and change. So it's really important that organisations do actually take a deep look into their processes, so that they can actually gain the efficiencies of, a very well developed and secure product. The other thing that I would mention, I didn't mention in the presentation slot, was change in regulations. People are aware of secure customer authentication, which the deadline is March next year. The lodged and the virtual card products, they actually comply with secure customer authentication in the fact that they will be exempt. So again, that is further efficiencies and the organisations can benefit from.
Perfect. Thanks, Jeff.
Wonderful. Okay, well, look, we're at the hour mark, and that was a really, really interesting discussion, and one that will continue, I'm sure, over coming months and indeed years. The impacts of COVID is not going to be short-lived. So some of these things and embedding some of these ideas in your organisations is only going to increase in importance. Thanks for all your attendance, and thanks to the panel members for fielding questions and presenting. I think if there were one or two questions we didn't manage to get through, so I think the team will endeavour to get back to those people on those. But all that's left to say is thanks very much for attending.